What is up, investors? Bed Bath & Beyond, ticker symbol BBBY, just reported earnings after hours tonight. So we'll take a look at the stock. This on the heels of us reviewing Levi's, which had nearly a 48% decline in sales. Bed Bath & Beyond is experiencing the same thing. And you see here after hours, the stock is selling off tremendously, about 7%. And that is not boding well for anybody that is long Bed Bath & Beyond. We'll take a look at their press release. Some interesting things inside the press release we'll talk about. We'll look just briefly at a larger view, 18, 19, 20 top line and bottom line numbers. And then we'll jump into the most recent quarter to see how bad it was and to see if Bed Bath & Beyond has any chance at surviving the next 12 months as a retailer. Now, interesting, here's the press release. You know, companies always put things at the top, but there really wasn't a lot to sing about. They did say here net sales from digital channels, otherwise known as the internet, grew 82%. And so, hey, that's got to be really good, including 100% growth in April and May. And so as an investor, you might think, hey, that's really exciting. Unfortunately, gross margin decreased 780 basis points to a measly 26.7% because everything shifted to digital channels. And I saw commenters on financial blogs and on Twitter talking about, oh, you know, Bed Bath & Beyond's going to be so much better because they're going to sell all this stuff on the internet. Well, here's the problem. Bed Bath & Beyond rents space that cost out here in California like $2 a square foot. They're going to go up against Wayfair and Amazon as their primary competition. And I know for a fact, Wayfair and Amazon rent space out here in California that's like 25 cents a square foot. At least that's what it's published at. And I'm sure Wayfair and Amazon get a much better rate than that. They probably get all kinds of tax breaks as well. So that's the problem with Bed Bath & Beyond. To shift to a digital sales and shift to a company where a large percentage of your revenue is going to come in from digital, and then you're not only going to lose gross margin, you're going to gain gross margin. Well, you're going to have to invest significant amounts of money and shift the company around. I just don't see it. Back to the chart here. As we saw, this stock sold off tremendously a little bit after hours here. A solid 7%. We'll see what happens if there's a follow through tomorrow. The low on this stock, though, is really low. 52-week range is $3 all the way up to 18. We're kind of in the middle of that range. $3. We've got a market cap of $1.2 billion. We see here, this is a company that had $11 billion in sales. So this is a company that's already distressed from a valuation perspective. And you see the short interest here is 58%. They have a dividend here, but they've canceled that as well. So you can kind of wipe that out. But a $1.27 billion valuation, and this is a company with $11 billion in sales in the last calendar year. And so we'll take a look at the most recent quarter, but I wanted to give you a view here. This is where the company has been. They went from 12.3 down to 12 to 11.1 billion. So like most brick and mortar retailers, these guys are getting absolutely crushed by the Wayfairs and the Amazons of the world. Gross profit we see here is also trending down. They're not squeezing anything out of this cost of sales. Coming down to the net loss. Actually, the other thing I wanted to show here is your SG&A expenses. Notice, okay, sales are off $1.2 billion. Notice that SG&A cost is actually up over the last 2 years. That's a problem, and that is not something that is going to turn your stock around. Now, net loss here is they made $424 million back in March of 2018, and you could probably see that the stock probably was a lot higher back then. Not a lot higher, but it was in that $20 range when they were actually making money, and now they're losing money. The last year in 2019, they lost $137 million, and it accelerated very nicely to $613 million loss. Now, this company did announce somewhere in here that they're closing basically 1 in 5 stores that exist. So that is one way they are going to cut cost over the next year or so. Here we go, 200 Bed Bath & Beyonds over the next 2 years. And so that is going to, while that's going to save some money, in the short term, there's going to be impairment costs, lease breakup costs, a lot of other costs that are going to be associated with that as well. And also, it's going to be a lot of lost business as well. When you close this many stores, you're not going to be able to replace that dollar for dollar online when your company is not built for that. Now, into the most recent quarter, Bed Bath & Beyond just reported May. So this doesn't include June, which, as we know, some states are starting to open up, but now a lot of the states, including California out here and Texas and Arizona and Florida, they're starting to close again or put the brakes on things. So you can expect that Bed Bath & Beyond's next quarter results, while maybe they're not this ugly, a 49% decline on the top line, maybe they're going to stay this bad. And again, we saw that this is a company that had $11 billion. Probably a lot of their sales, I would guess, are concentrated in the fourth quarter or the Christmas quarter. And also a little bit of back to school. You got to figure colleges and, moving out and those kind of things. You're not going to have as many of those sales come to the company, since some of that is not going on as well. As we see here, massive decline on the top line that drove this bottom line. Ooh, look at this ugly gross profit number of $348 million. That is super ugly, because when you take in account the selling, general, administration expense didn't come down much. Again, our revenues dropped by 40, I think it's 49%. And look at this. This barely drops. This is like $170 million. That is not good when gross profit dropped by over $500 million. So that leads to a massive operating loss of $460 million. Again, we saw for a whole year in 2020, or in 2019, quarter ended in February 29, 2020, $600 million loss. The previous year, $137 million loss. In just one quarter, this company lost $460 million. Okay, from an operating perspective. Now, from the net loss, once we take into account some of this other stuff, it is still a massive $300 loss. Ironically, it is actually an improvement over the previous year. So we are seeing a little bit of an improvement there from Bed Bath & Beyond. Let's dip into actually the cash flow statement. Here is Bed Bath & Beyond's cash flow statement, because as you know, following this channel, the net loss does have some non-cash items. And when you're analyzing a company like this, you kind of want to see how some of this stuff is revolving from a cash basis. As we move through this, we've got some stock-based compensation, some other stuff that can be added back in. But here we go. Net cash used in or provided by operating activities, massive. $395 million left the company from an operating perspective on the cash flow. That is compared to a $90 million cash flow positive quarter in the previous period. This is an absolute disaster. Now, let's zoom back up to the balance sheet, because when you take into account, they lost $300 million from a net income perspective, $300 million from a cash flow perspective. Is this company going to be able to survive this? Because look, the stores are a lot of the stores are probably closed. They're going to close 200 more over the next 2 years. Is this company going to be able to survive? Cash and cash equivalents here, $1.1 billion. We notice it ticked up a little bit, probably coming from some kind of debt raise, some kind of fundraising activity, obviously not related to the operations. We've got short-term securities. Look like they've cashed out quite a few. This is where most of the cash came from. It looks like they had 385 in the short term. Well, that went down to 30. And so you can figure most of this went into current cash. Now, the next thing you want to look at is merchandise inventory. You went from 2.1 billion all the way up to 2.2 billion. They've got a lot of inventory on the balance sheet. That is not good. You also notice here's another real sneaky thing to kind of look at. Prepaid expenses, $248 million in the previous period, up over $100 million. Sometimes this, when vendors and contractor, anybody that Bed Bath & Beyond has to prepay expenses to, I know this is on the asset side, okay? And so for some people, they might think, oh, anything on the asset side is good. Not necessarily. This is why you watch this channel and not some of these other channels that are just puff pieces for the high-flying stocks out there. You actually learn something on this channel. They increased their prepaid expenses by $100 million. I would guess because they have vendors and people that they owe expenses to that are not allowing them kind of the generous terms that they did back in February 2020. Now they got to start paying up. And so that's not a good sign, in my opinion. So we've got total assets here of $7 billion. They ticked down a little bit as well, but the bulk of the current assets are tied up in this inventory, and that is not good, especially when you're going to be closing stores. A lot of that inventory, sure, it might get transferred to other stores, but it's probably going to go to TJ Maxx. It's going to be liquidated. I actually have a store in my town that just advertised that they got a bunch of Bed Bath & Beyond inventory in. And so Bed Bath & Beyond is already dumping inventory and this is like a bargain discount place. And so how are they going to raise margins when they're dumping this stuff off to the discount retailers? They're not going to be able to do it. Total liabilities here, we see accounts payable. That is still a big number. Okay, again, they have we'll give them a benefit of the doubt, $1.2 billion in cash, but they have accounts payable of $900 million. They have accrued expenses of $600 million. They have some merchandise credits here. They have some operating leases. Maybe that's a current liability. That's $500 million. We've got long-term debt out here at $1.7 billion. That is up from $1.5 billion just a couple months ago. This is not good. This is not good. Total liabilities ticked up $200 million, but it's not a good looking situation here. When you have $1.2 billion in cash, you've bled through $300 million in the quarter. I'm going to guess in the next quarter, they'd be lucky to just lose $100 million, $200 million operating. It could be just as bad or worse in the next quarter, which would leave them south of $1 billion in cash. They probably won't chew through much of this inventory. If they do sell it, it's probably going to be for low margin or dumping it off to discount retailers. They have mountains of debt. They have other liabilities that are payable here in the next 12 months. Guys, when you add this all up, there's a reason why you've got a $1.2 billion valuation on a company that has $11 billion in sales in the last 12 months and $1.2 billion in cash and $2.2 billion in inventory. Wall Street is not giving this company credit for anything. Now, you might say, well, I'm going to go run out and buy put options, or I'm going to sell this thing short. Well, okay, maybe you join this 58%, and certainly I think the play might have been try to gamble before earnings, seeing what happened to Levi's, seeing what happened to Nike, seeing what happened to Ulta Beauty. I think you could telegraph what's going to happen to Bed Bath & Beyond, Ross stores, Kohl's stores, any kind of retail store that was closed. Their revenue top line is probably going to diminish by at least 40 to 50% at the bare minimum. And especially the ones that didn't have any kind of internet presence, they're probably going to trend down even further. But again, this is a stock that's already been beaten down to a pulp here at a $1 billion valuation. I think both sides of the play here is very, very risky. To say, I'm going to bottom feed here on Bed Bath and think they're going to turn it around, I think that's risky. To say, hey, I'm going to sell this short and maybe we retest these $3 low, well, that's a little risky too, because then you're getting down to a $400 or $500 million valuation, and somebody might come in and bottom feed and kind of scoop this up. You always hear the rumors that Amazon's going to buy Kohl's, or Amazon's going to buy this retailer, or Amazon's going to buy a movie theater. There's all these rumors out there that get floated around, and when you get down to this low valuation, now you do have to factor in that valuation is not factoring in that whoever scoops this company up is going to be on the hook for $6.2 billion worth of liabilities as well. So there, at some point, private equity or somebody might come in and try to rescue this, or this company is going to go bankrupt. I think those are the only two options. And for me, that is not a good option to go long a stock. That the two best options are bankruptcy, or some kind of private equity group is going to come and squeeze the necks of management and force them to sell for pennies on the dollar. I think that's the future for Bed Bath & Beyond. I think it's a future for lots of retailers, especially the ones that were closed. Not Costco, not Walmart, not the grocery stores, but retailers like Bed Bath & Beyond that are easily replaceable by a Target, by a Walmart, but also by Amazon and Wayfair and other online retailers as well out there that have far less footprint in expensive real estate like Bed Bath & Beyond does. So I would avoid this one. I think the play is check earnings in the next few weeks if you want to make some risky trades, which I don't really endorse here on the program, but I would look for some other retailers that have been closed. Guess what? Their sales are going to miss massively, and they're probably going to announce that they're closing stores, that they're realigning things, that things are bad. And the longer things stay closed, the next couple weeks to months, the worse it's going to get. And again, I think the best outcome for Bed Bath & Beyond is have some private equity or a white knight like Amazon come bail them out for pennies on the dollar on the market cap, or they're just going to go bankrupt. And that's the sad state where we are today in some of these retail spots, especially the non-essential ones. So there we go. Earnings season's in full force. I'll be back tomorrow and the rest of the week with another video of a company that people have suggested I cover here on the channel. If you have a stock you'd like for me to cover here on the channel, please leave me a comment below. I'd love to hear from you. Hit that subscribe button if you appreciate our content and that like button as well. Good luck with your investments.